So I do have one guest speaker. It's going to come sometime in March. He's USA's catastrophe risk management and reinsurance actuary. He's spoken before, a really, really sharp guy, very, very highly respected in industry and retired, so he can say whatever he wants to now. I'm still working on a commercial person. I have three alternatives I'm working on since I don't know the commercial side as well. There was one of the women that was at the event last time. Her company does some really bizarre products, which I think you'd find really interesting if she's willing to talk about them, but she might consider them too proprietary. So we'll see if I can get her to come. So I've decided not to do the cat person, the catastrophe bond person, just because I think we've covered everything. It becomes a little too much detail. So last couple of classes, we've been talking about parts B and C of the auto. I wanted to show you, I forgot to do this document while we are doing that, but I went out to the internet to find the arguments for why you should buy B and C. You find it really tough to find people arguing why you shouldn't buy it. So I'm out there all by myself. You can find plenty of people saying that you should buy it. So if we look at these arguments, so these are just cut and paste from the internet. Their argument is your financial losses would include medical expenses. So that to me is health insurance, which you reasonably required as a result, which you reasonably required as a result of an incident, any loss of income. So that's disability insurance, diminution in your ability to earn money. That's disability again. One thing you'll notice with these arguments is they have this long list of stuff that you need, and it's the same thing repeated at different words. So you take a list of 3 things and you convert it into 20 things by just so loss of income and loss of earnings, diminution in your ability to earn money. That's the exact same thing as loss of income. Any sort of out-of-pocket expenses. So here's the thing. You're going to need someone to come help you with cleaning the house or other things. That to me is a low severity event. I've hired people to come clean my house before. I don't like to anymore because I usually clean the house the day they're coming because I don't like people coming to my house when it's dirty because it kind of defeats the purpose. I mean, it worked really well because I kept cleaning my house for the service to come up and clean my house. It's not that expensive. My Spanish teacher in Peru, she says everybody has housekeepers here, even the lower income people. Everybody hires house. I said, man, it's like so yeah, in the U.S. y'all don't do that, but it's not that expensive for most people. And then this is the big one: is pain and suffering. That's the one you're giving up. You won't get that covered unless you have B and C. I don't care about pain and suffering. I mean, it's bad, but giving me money doesn't help. If I'm in a lot of pain, give me $100,000 doesn't make me feel any better. To me, pain and suffering is a lot worse than not getting money. But some people, it's important. I had one person in this class say she'd be willing to take severe pain the rest of her life if you gave her $1 million. I was like, that's crazy. I would never. Any of y'all in that camp? $1 million? Maybe someone whose family's in bad shape, they'll sacrifice everything for their family or something. But yeah, I can't imagine pain for the rest of my life. That wouldn't be worth it. So this is talking about the uninsured motorists. So death insurance or life insurance is important. Best use of these resources is you need all of this coverage except for pain and suffering. That's the one thing you got to decide if that's important. You can't get that with any other coverage. You need medical insurance, you need disability insurance, you need life insurance, you need all these things. But if you buy parts B and C, you're spending money on B and C you could spend on those other things. And B and C is only going to cover you if it's related to an auto accident with an uninsured person or a medical. It's so specific. That's why it doesn't cost as much as these others. So my argument is take that money you're spending on B and C and buy the insurance you should have. People saying, I need B and C because I don't have health insurance, that just to me is kind of a crazy question. Now here's someone who's proving you should buy the insurance because they had a claim. That's like someone proving going to Vegas and and gambling makes sense because they won money in Vegas. It's not a good argument. So of course, the claim trigger my collision deductible. So the deductible, yeah, you've got that. You will get that covered if you have part B, you have part C, and was going to be counted as a not. Now he's making an argument that it's going to raise his rates. If the other driver's at fault, it shouldn't raise your rates. If the other driver's uninsured, it shouldn't raise your rates. He's arguing that will be the case. I don't believe that's true, but that's what he's arguing. So he's saying since I had the uninsured, and it was hit and run, I don't have to worry about my rates being. Well, why would the insurance company say, well, if you follow it under Part C, we're not going to raise your rates, but if you follow it under Part D, we're going to raise your rates? That doesn't make sense. If someone else is at fault, the insurance company should put that in their database the same way. So he saved $250 on his deductible. Not counting against his premium if his policy renews. I don't think it would have anyway. And this is the phrase I dislike the most because I strongly disagree with this. This is a prime example, as with all insurance, of why it's a good idea to have as much coverage as possible. That's absolutely false. Because what I say with insurance, you're always paying more than you expected to receive. So that's not a good reason. Without uninsured motorist coverage, I would have been hooked for more than twice what I ended up paying. He's talking a couple $100 here. You know, you look at the rate online on that, he's going to probably spend $150 for this insurance in order to save himself a couple $100. It's just not worth it. And the argument I had with the lawyer online, his perspective, I think, was a little skewed because he does these cases. So in his mind, there's millions and millions of these. But if this person were to instead spend the money, say, on life insurance, if you really sit down and make a list of all the people you know that have been seriously injured by uninsured motorists, and how many people you know who've seen someone die early, prematurely, you can probably think of more of the latter than the former. There really aren't that many cases. He's seen a bunch of them because that's what he does as a living. But I bet you don't know that many people that have been seriously injured. You may have people that have had an accident with uninsured motorists, but it's just not that common. First of all, we don't have that many accidents. Second of all, uninsured is about 20–25%. So even then, it's not that many. Third, it has to be a pretty serious accident for this to be worth it. And fourth, you've got coverage already. So we're just talking about a little bit of extra coverage. It's not like if the bill is $3,000, this is going to save you $3,000. It's going to save you whatever your insurance you already had is versus this insurance. And you're talking maybe a few extra $100. I just don't think it's worth it. Here's a third example. First, it also covers you if you're a pedestrian hit by an uninsured motorist, but again, covered for what? Health insurance, disability insurance, the exact same thing. So medical expenses, lost wages. You could get coverage for loss. You could get this stuff, but if you switch jobs, you could lose it. Yeah, that's true. Anytime you switch jobs, make sure you get your health insurance or disability insurance. Here's the argument it makes. You may have people in your car who don't have health insurance. That's kind of their problem. You know, I tell people, hey, I had one of our students, he needed to walk across the highway to get his car. Hey, I'll give you a ride, but I don't have part B and C. It's like, just make sure you know. He's like, yeah, that's fine. I have health insurance. He says, you probably can't afford to drive without it. Yeah, you probably can. The fourth example, I love this. All of these benefits, man, a long list of them. Pain, suffering, disability, scarring, disfigurement. Man, scarring's bad, but disfigurement's bad. Mental anguish, that's pain and suffering. Loss of enjoyment in life, that's pain and suffering. Lost earnings, that's disability. Lost earnings capacity, that's disability, as well as medical expenses. What is all of this? Pain and suffering, medical, and disability. It's three things, but he got a good list. You could probably come up with 20 more. Think of just go out to review thesaurus. Sorrow, grief, misery, woe, anguish, travail. You could put all of those on the list. Man, it covers all of those things. I mean, that's all he's doing there. So every day throughout the state of Florida, hundreds of people are seriously injured. Following a serious accident, injured person will immediately be considered who will compensate me for this. I mean, all of that's true, but you have insurance already covering that. Um, he's kind of arguing that if you use health insurance and then you sue that other driver to cover your medical bills, they're saying that it's not good because Medicare, if you had $3,000 in harm and you sue the other driver, get $3,000, Medicare is going to take that 3,000 because they paid the 3,000. Essentially saying you can't double up, and that's the way it should be, right? If the insurance company pays for it, they should have the right to get whatever you sue them for. I wish I could give you the Walmart case. I had trouble finding it. One student found it. If I can find it, I'll show it to you because I think it's a huge issue when we're talking about the personal injury side of this and lawyers. So this woman worked for Walmart. She was hit by a professional truck driver. It was his fault, caused a really serious harm. They sued the trucking company, and the lawyer, what I think is the worst part of the whole story is the lawyer got most of the money. She got less than half of the money, but what she got wasn't adequate to cover her expenses. So Walmart is paying her medical, and Walmart says, hey, if you sue and you get money, we get that money. So Walmart took that money from her that she got in the lawsuit. Walmart got beat up in the press for doing that. Walmart argument was they had no choice because that's what their contract said. I think Walmart should still have let her keep the money given how serious the case was and it wasn't that material. I read that case, so I'm not as mad as Walmart as I am at her lawyer because he obviously didn't sue for enough, and then he took more than half the money. He came out way ahead, and she didn't have enough. But it's an interesting case of Walmart saying, "Hey, if you sue and you get money, you got to reimburse us because we're paying employee benefits. It's a trust. It's the employee's money. It's not our money. If we pay you and you get reimbursed, you got to reimburse the healthcare plan." It sounds heartless from Walmart's side. If I were they, I would have reimbursed the health plan and I would have let her keep the money and just have done it because it was a really sad story when it hit the press. Walmart really looked pretty horrible, but it does show you the legal system is the one that really makes the money in these. Um, yeah, this is absolutely crazy. Carry the maximum amount that you can afford. That's never true with insurance. Um, And then here they say on the medical payments only may give you greater flexibility in care. What I've discovered in people who have it is it creates incredible fights between the auto insurance company and the health insurance company. If you don't have it, all of that goes away. You just go right to your health insurance company and it's there. I don't like it, but I won't convince any of y'all to get out of it. So I'm just giving you my argument. But make sure when you're buying insurance, you know what you're buying. So how many of y'all know you have B and C yet? Y'all checked? Do you have it? Yeah, I mean, that's fine. You can keep it. Anybody else? Anybody here not know if they have it or not? Is that the majority of you? Yeah, so you're buying insurance, you don't know if you have it or not. So I would go check, see how much it is. If it's $18,000, I'd probably cancel it. If it's $12, you might keep it. Mine was about 150 bucks. I forgot to go check and see how much it is now. But anyway. All right, let's switch to a controversial topic. This is an exam question for exam 2. And if you look on Canvas, it's under auto insurance. The article we just did was this first one, the debate on parts B and C. So there's 3 articles. We're going to focus on the first 2. They are highlighted because you don't have to read every single word. If I give you articles already highlighted, you are okay just reading the highlights. You don't really have to read everything. But we're taking advantage of the fact that credit scores were a huge issue about 20 years ago, and Texas did a major study. And it's perfect for this class because it shows you the actuarial side of these debates and how actuaries get involved in here. It is very controversial. Um, there's Jose Montemayor again. So he was our insurance commissioner of the state of Texas during those two huge events, mold in Texas and this credit score. He was also heavily involved in setting up the Texas wind pool. So he was we were very fortunate to have him. I say we from the insurance industry side because he was a very pro industry. Uh, he was fair, but also definitely listened to the industry side. I want to start with the second article first. If you want to load these up from Canvas, start with the second article first, and you'll see why. So, first of all, do you know what credit scores are? What's another word for credit score? Your FICO score, right? Fair Isaac, oh man, there is I think a business breakdown on Fair Isaac, and I don't know, I forget where the name Isaac comes from. And I don't know if they tell you what it stands for. What does FICO stand for? Fair Isaac something. Fair Isaac Corporation. I guess the co is corporation. So it's the FICO score now. You can get your score. I'm always surprised at how mine's lower than I thought it would be because I haven't had debt my entire life. But supposedly, if you don't have debt, you can't get the full score. So I have credit cards. I pay them off every month. I buy cars with cash. So I don't know why my score is not perfect, but it's high. But I don't really care because I don't borrow money. But FICO score, it's an assessment using a lot of different information. You could probably find the formula out there somewhere. So payment history, how much you owe, how long you've had credit, new credit, your credit mix. Obviously, if you miss payments, that's going to be huge for insurance companies. So companies can use FICO scores to determine how you pay them. So they can decide, hey, if you're going to buy this, you got to pay up front with cash. We can't put this on credit. But that's not what insurance companies are doing. They're doing it to set your insurance rate. And it might seem unfair. And that's what happened with the state of Texas. The Texas legislature commissioned or told the insurance commissioner, do a study of credit scores. We want to figure out if this works. So when you answer this on the exam, I'm real picky on this. Let's see if I can summarize this better as we go. I think it's in the class notes pretty well as well. So the key is there were two studies. So let's look high level. If we get this down, the rest of it falls in place pretty well. So study one had two questions. And then you had study two was a follow-up question. So this first study, the state asked them, is the use of credit scores impacting different groups, especially protected groups, differently? That's the first question. They didn't ask men versus women, but they did ask on age, they asked on race, they asked on income. So some of it seems pretty obvious. If you can use credit scores, it seems pretty obvious it's going to impact low income more than high income. That seems pretty obvious, doesn't it? But age obviously makes sense. Young people are going to have worse credit scores just because they don't have the history. So obviously going to pick them more. And you might, and especially you young male drivers that get charged so much for insurance just because you're a man and you're young. You might say, okay, this seems like piling on because I'm also have a low credit score because I'm young. So you're charging me 3 times. So we'll have to ask the question, and that's where the second study comes in. Is there a relationship between claims and credit scores? That's the second question. Are they predictive of auto claims? They're also doing home as well. So they're looking at both homeowners and auto. We're really focused on auto. It's a bigger deal for auto. Are they predictive? The follow-up question was, are they independently predictive? So you might say, well, credit scores are predictive. People with low credit scores, man, they drive a lot worse. Well, let's bring age in. Let's bring in your geography, your driving history. Let's bring in all those other things. It's possible only thing credit score is telling you is who are the young people, because young people have worse credit scores than older people. If that's the case, just use age. Don't put credit score in there. So the question is, does credit scores provide additional information on claims over the other factors? I should probably put that in there, over other factors. And you'll see the wording they use. Jose Montemayor is kind of similar to Warren Buffett. He knows how to put phrases together that sound really, he must have worked on them, or he had someone in his department write them. All right, so 3 questions, 2 studies in the first one. What do you think they found on this first one? Is there a relationship between the use of credit scores? Is it impacting different groups differently? Definitely yes. Are they predictive? Insurance companies say absolutely yes. If you ask an actuary this, they don't even think, they don't even blink. They say absolutely. This is something actuaries say, wow, this not only have we discovered credit scores predict accidents, it's one of the best factors out there. And then the next question is it that they're predictive, or are they just redundant with other factors? And the answer here is they are predictive. They provide information age and other things do not provide. All right, so that's what we're after here. And the answers was yes, yes, and yes. So Montemayor had to say, okay, I can't do anything about it. The only way I can not allow insurance companies to use credit scores is if the state of Texas makes it illegal. They are illegal in California. You can't use credit scores, but in Texas you can. Why? And we'll look at why that's the case. So let's look at this first one. The reason I'm starting with the second article is Montemayor has this letter to the governor. In the letter, he does a great job of summarizing the entire thing. So I start with the letter because it does a great job of summarizing it. So there's some definitions here. The first one, you're going to see pretty quickly. I'm going to actually jump down to it. Related to this first questions, it's important to understand there are 3 types of discrimination. I don't really care if you get the titles right because to me they're backwards. They don't make sense the way they have them. So those 3 definitions are unfair discrimination, intentional discrimination, and disproportionate impact. I would probably switch the definition of the first 2. To me, the unfair discrimination sounds like intentional, and the intentional sounds unfair, but for some reason, they switch them. So unfair discrimination, you charge people of the same risk different rates. So you say, okay, you know what? I don't like blonde-headed people. My family's all brown-haired. I'm going to charge blonde-haired people 20% more. I just don't like them. They have this attitude, whatever. I'm not saying I believe that. I'm just making something up here. So I'm going to charge them 20% more. You can't do that. That's illegal. So what the state says, you must have actuarial data that shows a difference in risk to charge different rates. They call that unfair discrimination. I would call it intentional. That's called unfair. If you read the article, the Texas Insurance Code defines unfair discrimination to be the unequal treatment of individuals in the same class or hazard, essentially the same risk. Underwriting or rating classifications are not unfair if they are actuarially supported. Insurance is pretty unique. There's very few companies, businesses that can discriminate based on age and based on gender. Insurance can charge young people more than old people. It can charge men more than women. It's pretty unique. Why can they do that? Because they can show women are better drivers than men. Young people are worse drivers than older people. Married people drive better than single people. They have the data to show it. Because they have the data to show it, they're allowed to discriminate. Intentional discrimination is different rates based on protected groups. You can think of race, ethnicity, and that's even if you can show a difference in risk. So even you can show that green people drive worse than purple people, the state of Texas protects those groups, so you can't charge them differently, even if you have the data. So just from the state of Texas, on the other hand, overt classifications or discriminations based on race, color, religion, national origin, are intentional discrimination are prohibited by law, regardless of actuarial support. The last one, and it was interesting when Jose Montevideo talked to the class, he says this thing doesn't even exist. He doesn't like this term. He felt like he was forced to use it. I've heard it used in other contexts, but disproportionate impact. Different groups are impacted differently, but they are not factor being graded. It's kind of a hard thing to say. So if purple people just happen to have worse credit scores than green people, they're going to pay more for insurance, but you're not charging them more because they're purple. You're charging them more because of their credit scores. It just happens to impact them more, and that's called disproportionate. And that is legal. You can do that in insurance. Now, this is when he gets kind of fancy in his wording. He says disproportionate impact is a lack of symmetry or unequal percentages. In other words, disproportionate impact is an uneven distribution of each race or group within a given risk factor, although the uneven distribution is not caused by one's race. So the best way to test this is to take a particular group of people and take credit scores and see within that group of people, do the people with good credit scores drive better than people with weak credit scores? And you find, yes, that's true. So within that group, it's still true. Then when you apply credit scores, that group, the good credit scores do better than bad credit scores driving wise, but they may have more bad credit scores than the other group. So that's disproportionate impact. By the nature, he's just going to say that's the way insurance is. By the nature, risk-based pricing and underwriting, all factors used in insurance have a disproportionate impact to some extent. This has been a big issue for the homeowners industry. Jesse Jackson just passed away. I don't know if y'all saw that in the news. He worked a lot with the insurance industry for something he referred to as redlining, because there were certain neighborhoods that could not buy homeowners insurance because of the crime rate or whatever else. And he went to the insurance industry and said, man, this is unfair. You're treating these people poorly. And the insurance industry, they came to some compromise over time. Jesse Jackson didn't get everything he wanted, but he did get some concessions from the insurance industry. That would be a disproportionate impact. One could make a convincing argument to ban the use of all risk-related factors. Essentially, everybody gets charged the exact same rate. Would you want that? Every single driver gets the exact same auto rate? Well, if I'm a 23-year-old male driver, yeah, maybe I'd like that until I turn 25. That'd be kind of nice. If I'm a 47-year-old married female driver, no, I wouldn't, because I'm going to be paying a lot more. But he says if you don't want disproportionate impact, you just charge everybody the exact same rate. There are places that do that. France, you cannot discriminate based on sex. And so what does that mean? Women overpay for auto insurance. They overpay for life insurance. Why? Because they're better risk and they're having to pay the average rates. Are you helping everyone by eliminating disproportionate impact? And it's impossible, right? What if you say you can't use credit scores? Whom are you helping? People with low credit scores. Whom are you hurting? People with good credit scores. I remember listening on WOAI 1200. They had a big debate about credit scores, and the poor guy from Allstate was on the radio show, and that poor guy got beat up. But the sense was, it's unfair using credit scores to raise my rates. And there's this thought that if insurance companies stopped using credit scores, my rates would come down. But no, some rates would come down, other rates would go up. Not everybody can win. So that's the disproportionate impact. Effectively, we would ban risk-based pricing and underwriting to revert to a price system where we homogenize the risk and pricing and underwriting, essentially charge everyone the same price. There is a movement in some states to eliminate insurance companies, and you buy insurance when you buy gasoline, and it's called pay at the pump. That some people like that until EVs came along. And then essentially people buying EVs get free insurance, right? Because you don't ever have to buy gasoline. But the thought was, and it's not well thought out, but the thought was people who drive more would buy more gasoline, so they should pay more for insurance. But there's also the gas mileage and other things. I've got a plug-in hybrid. I buy gas once every 2 years. So I kind of like pay at the pump. I mean, great. I went the entire year 2025 of that or buy gasoline. So they'd have to find some other way to do that. Essentially, it says there's only one factor, and it's how many miles you drive. Nothing else should matter. It shouldn't matter if you're male or female, or if you're 20 or 40 or 50 or married or single. Nothing else matters. Doesn't matter if you've had 50 speeding tickets or 0. Everybody should pay the same. So can you get the sense that he doesn't like that solution? That would be a setback to all Texans of all races, especially those moderate, lower income whose risk remains low. As commissioner, I have the authority to end the first two, unfair discrimination, intentional discrimination. However, he doesn't have the ability to tell companies they can't do disproportionate impact. Only the legislature can do that. Now, he says this here. He did not say this in the class, but he said prior to that, the study, he said he thought credit scores were simply substituting for age and other things that were legal. And that if you just looked at age, and age is probably the most important one. If you just looked at age, that would be enough. You don't really need credit scores. He didn't say that in class. Remember, Jose Montiel was a statistician, a very impressive statistician. he had heard this issue before. He heard from actuaries before. He had already been convinced that credit scores made sense by themselves. I think he threw this in here to be a little kind of politically more sensitive. But he said, prior to the study, I thought credit scores use was superficial, really just supported by the strength of other variables. And that would mean credit scores were just a coincidental variable that served as a, I love, he's going to use this word surrogate again. I love it the way he uses it. As a surrogate for a non-lawful factor in rating underwriting. If this were proven, I would have the legal basis to make the connection between disproportionate impact. So if credit scores is a substitute for things, something like race or ethnicity or something like that, there's a one-to-one relationship, he couldn't use it. If he can show there's a protected group and this factor perfectly predicts that protected group, can't use it. But he says he couldn't do that. He could abandon it outright, that were the case. Are not allowed to be changing the premiums. The study, however, did not support those initial suspicions. Credit scoring, if continued, is not unfairly discriminating because there is a basis. It is not based on race. It is not a precise indicator of race, so he couldn't make it illegal. He does say if the presence of credit scores and insurance only feeds suspicion and invite us as Texans, its continued use to any degree may simply not be worth it. But Texas never did make it illegal. It is illegal. I think California is the only state, maybe. I don't know. There might be in one or another. All right. Any questions on that, the setup? So now we got to look at the data. So make sure in your exam answer you have these three discriminations. And again, I'm not real picky that you get the unfair versus the intentional, just that you understand what the three groups are. Do remember disproportionate impact. That is a pretty important term that came up during this analysis. So let's go to the original study now. Don't print it. It's 72 pages long. Most of it you won't care about at all because it's chart after chart after chart of just way too much precision. But we'll look at the highlighted pieces. So this is the first study. And this is where we're going to ask, does this have disproportionate impact? And is it useful for rating insurance policies? They got the data from 6 leading insurance groups. Probably UTSA was in there, State Farm, Allstate. 1.2 million auto, 800,000 homeowners. And when they did the homeowners, there was something else going on at the time that really messed up the numbers. Any guess what that might be? Another big issue with homeowners insurance. You remember mold? So they did this in the middle of the mold case and that messed up some of the numbers. So they weren't 100% sure on that. So here's the 2 questions. The department uses data to analyze whether the use of credit scoring impacts certain classes of individuals more than others, and does it predict claim experience? What 2 ways could you divide up claim experience, do you think, that you talked about on paper 1?
The frequency and severity.
Frequency and severity. So think about that. Is there a relationship between credit scores and frequency and severity? So if someone has a good credit score, what drives severity on auto insurance? Maybe the price of the car, possibly. You think people with good credit scores would have more expensive cars? Maybe not. Maybe that's why their credit score is good. They drive old pickup trucks like Warren Buffett. But there probably is some relationship, even more so on homeowners insurance. There's obviously a relationship between credit scores and homeowners because people with good credit scores are probably going to have more expensive houses. But if credit scores are useful, are they useful for predicting frequency or severity or both? Which would you think on auto insurance, frequency or severity? It is frequency, yeah. Almost no relationship severity. My question on severity is maybe because of that relationship between the price of the car and credit scores, maybe that offsets it either place. Homeowners, because of the mold issue, they said, man, we couldn't really tell. There's definitely a relationship there, but it's really, really hard to pinpoint it because the data's messed up. The individual policy data shows a consistent pattern differences in credit scores among the different groups. There appears to be a strong relationship between credit scores and claim experience on the aggregate basis. And here's where they set up the second study is necessary to evaluate if and to what extent credit scores enables insurers to more accurately predict losses. All right, so something you want to put in your essay are these two terms. The first study was a univariate study. I may not have spelled that correctly. Let's see. It may not even be in here. I'll highlight it so I can maybe spell it right. The second study was a multivariate analysis. So the first study just took credit scores, looked at frequency and severity, and said, can you predict frequency and severity from credit scores? Second study said, okay, let's look at other factors and see what else is going on here. So a good example here, we're talking about a good way to think about this is correlation versus causation. What do actuaries care about? They care about correlation. Do you think low credit scores cause people to drive badly? Do you think that's it? It's like, man, my credit score dropped and man, I'm just having accidents all over the place. You get that credit score up so I drive better. No, so what's maybe going on? It's possible there's something causing low credit scores and causing bad driving that causes both of them. That might be someone's responsibility. They're taking care of things or whatever, but actuaries don't care. If they find if credit scores has been caused by A, bad driving is caused by A, but credit scores can figure out that they don't care. Give me that correlation. Causation is A causes B. So essentially what I think's happened is A causes B, A causes C, use B to forecast C. I think that's what the insurance industry is doing. Why? Because they can't get their hands on A, whatever that is. But they can get that in. So you can have high correlation without any causation whatsoever. I can put a bucket in my front yard and I notice every time it rains hard, the bucket's full of water. And I go, man, when the bucket doesn't have any water in it, it doesn't rain. When the bucket has water in it, it rains. Man, that bucket is causing it to rain. And, anytime it has water in it, it causes it to rain. I'm going to use that bucket to predict rain. Probably wouldn't work out too well, but there's a high correlation between those two. Insurance companies simply do not care. What they care about is where's the data. So they have data for B. They need to forecast C. That's all they care about. So they're looking for correlation. And the first study, all they did was look at credit scores and compare that to frequency and severity. Didn't ask if there was other factors that would have been just as good. The second study, they looked at credit scores in relation to other factors. There are some things in here that I thought were important because it shows that the data wasn't perfect. They don't have the data that they need. So one of the things they wanted to study was income. It seems obvious lower income would have worse credit scores than high income, you would assume, although I know some wealthy people with horrible credit scores because they overspend. But there is a relationship, but they don't have income data because insurance companies don't collect income data. So they essentially took zip code and try to guess people's income based on their zip code. So I can't remember if they looked at age. I think they looked at age. We'll see. It'd be in there. The individual policy or data shows a consistent pattern, different credit score. Oh, there it is. The next one. Individual age. Younger people have worse credit scores than older people. The number of credit-related consumer complaints increased substantially. So the insurance industry started doing this, and they started getting complaints. People with low credit scores are like, why are my rates going up? It's because your credit score is low. And remember, insurance companies can get a lot of this information without asking your permission. One of our students works for Equifax. Equifax does this kind of stuff. It was pretty interesting listening to him. Equifax had a big blow up not too long ago where some of their data got cyber stolen. Not in his department, but there are agencies out there that's their whole existence, is to provide this information to insurance companies and other groups to help them with their pricing. So they got a big chunk of the market. So the insurers they brought in represented 42% of the homeowners market and 55% of the auto insurance market. There are some companies that use credit scores to accept or reject, and they're doing it based on payment, not based on frequency and severity. They just say, hey, because insurance, you don't pay it all up front, you pay it out over time. And if someone's going to make the first payment and miss all the others, it's an incredible waste of money for the insurance company to set them up. And so if they say it's this person who doesn't pay their bills, they're rejecting them not because of their risky driver, to reject them because it's just expensive to have to deal with someone who doesn't pay their bills. Based on department's review, this is pretty important. Rates varied as little as 11% up to 400% based on credit scores. And there's a chart that will show that. We'll see pretty soon here. All right, so here's the charge. There's a law passed requires the Texas Department of Insurance to present a report to the governor and all these other people regarding the use of credit score by Texans, by Texas insurers. So credit scores are a statistical model. What are companies doing now? There's some debate about them using your social media and catching stuff like that, right? It makes us kind of nervous. What data do they have? What's legal? What's not legal? So it's interesting to see what they actually collect. Do you think AI is involved here at all? Probably taking this over. It's a mathematical formula. The inputs of the formula have various credit-related statistics. So they may not be taking the FICO score itself. They may be creating their own. That's what some companies have gotten in trouble with, is we're not using credit scores, but they're using all the data for credit scores and essentially backing into it that way. So here's the complaints. You can see when companies started using credit scores. Here's the rate impact for auto. Some people saw their rates reduce as much as 40% because they had good credit scores. Some people saw the rates increase as much as 60% because they had bad credit scores. That's pretty significant. The bulk of it was minus 20 to positive 10, which is still fairly significant. So less than 5% was out on the tells. About 10% though are well, more, about 15, 16, 17, 18% was 30%, 20 to 30%. And you almost get a sense more people are benefiting than getting hurt because this group is helping. So you have some really, really bad drivers up here. What happens if you don't use credit scores? What are these people likely to do? You say, you know what, your rate just went up 40% because you have good credit scores. What are they likely to do? Go without insurance, cancel coverage, get less coverage. If these people start dropping out, what happens to insurance rates? They're going to go up for the rest of the group, right? So If you make it illegal, these people are going to get out because they're paying too much. That's going to shift more to this group, so they'll get out. If you don't allow it to be used, you could at the end end up with no one's getting insurance except for this very last group because everybody else is just irritating, have to pay so much more. The question is it enough that people notice? These people notice if you eliminate credit scores use? Do you think in California, this group is noticing they're now paying 40% more on auto insurance than they were before? I guess is they probably are. Would that be enough to move out of California? Who knows? Maybe not. Insurance is fairly expensive, but there's other reasons not to move. The vast majority, 90%, have rate swings from 40% to 40%. Almost 10% experience more than 40% increase. Homeowners impact not nearly as dramatic. 90% are in the 30% range. I think you can see that the homeowners is much more compacted. And it's interesting on the homeowners, if we're talking about this as kind of an idea of responsibility and taking care of stuff, people aren't good with credit and they're also kind of not paying attention when they're driving. Maybe there's a relationship there. Homeowners is a little bit different. And here, I think you might have an issue of people are essentially their credit scores are lower because they're in a tougher situation. And you could probably make an argument that Jesse Jackson was making that you're really kind of piling on these poor people who are already paying the price for where they're living. So I mean, you can make some arguments the homeowners might be more even unfair. I think when you looked at the complaints, there was more complaints on homeowners than on auto, and that could have been related to that issue. It gets a little bit of a feeling like redlining. Insurance companies argue, so this is really, really critical. There's some terms the insurance company loves to use. You'll hear some people talk about affordable. The insurance industry likes to use the word availability. So affordable is, can you afford the insurance? So bad drivers can't afford the insurance because they're really bad drivers. Insurance is expensive. Insurance companies don't think of that like that. They think about availability. If you allow us to price the products correctly, we can make it available to all the drivers. If you allow us to charge high-risk drivers more, we can make the insurance available. If you allow us to give a discount to good drivers, we can make insurance available. They focus on availability. They say, if you don't let us charge the correct rate, we might leave the market. We're going to just not insure certain groups at all, make it available. You could ask the question, is it really available if it's not affordable? Say, okay, well, provide insurance to them at $10,000 a year, so we made it available. But if they can't afford it, is it really available? But you'll hear those affordability versus availability. Availability is the industry's term. These are the consumer groups. You don't hear insurance companies talking about their insurance being affordable. Why? Because they think they're charging the right rate for the right risk. You're paying what you should pay based on your risk. So from an availability perspective, insurance companies argue that the use of credit scores improves their ability to measure risk and therefore allows them to expand the spectrum of risk they write. This benefits consumers because insurance may become more available and may be particularly beneficial to more marginal applications who might otherwise be declining coverage. So a good example is you've got a young driver and a male driver, maybe 22 years old, and he's like, man, I can't afford my insurance, but hey, I've got a really good credit score. All right, we can sell the insurance. So his credit score offsets the fact that he's a young male driver. Says, wow, look at that. I can improve this. One thing I want you to think about, and that's why I think this would be a really, really good paper 2 topic is telematics. Is it possible to telematics can take over this entire thing. So what does telematics do? It has the recording device in your car telling the insurance company how you drive. What's a part of a false positive? Someone with a low credit score, but is a good driver. That would be a false positive. Could telematics help that person out? Say, yeah, I got bad credit scores, but look at my driving. You've been watching my driving. I don't speed. I don't make jackrabbit starts. I don't slam on the brake frequently. I'm not on my phone. Is that better information in credit scores? Can that offset it to eliminate the false positive? So there's a lot of issues coming up. Telematics might be the thing that somewhat saves the insurance industry. That maybe telematics eliminates or at least reduces the need for credit scores. So this study raises some questions they didn't ask because telematics wasn't around when they did this study. But the benefits to consumers because maybe more available. And there are people, even in those marginal groups, that if they have good credit scores, the use of credit scores is actually going to help that group. Before, without that, they may have been blocked out of the market entirely. The increased rates for policyholders with below average credit score or high risk may make insurance unaffordable. That's not the insurance industry saying that, that's the consumer groups. So that's kind of my point. If it's unaffordable, it's essentially unavailable. Now, you as members of society, do you want the insurance industry to do whatever it can to keep dangerous drivers on their street? Because they can't afford insurance. Do you want them to trying their best to keep dangerous drivers on the street? Does that sound like a good solution for society? If the insurance industry has a good model that says this group are bad drivers because they have bad credit scores, do you want to eliminate that and let those drivers be out there? And your answer might be, well, I got a bad credit score, so yes, I want to eliminate that, or have a good credit score, no. But the insurance industry is, you can see their position. We just want to charge the right rate for the risk, period. They're fairly heartless. It's like, not saying actuaries are heartless, but they're very number-oriented people. This person is riskier, charge them more. Maybe when they go home at night, they say, well, that poor guy has got a rough life. Why are we charging him more? But when they're on the job, give me the data. Some consumers may question the relevance, where they don't question the relevance of age or driving record. So credit score is one of those things they tend to say, I can see why someone with 10 speeding tickets pays more. I can see why a 20-year-old pays more than a 40-year-old, but why does someone with a bad credit score pay more? And the insurance industry says, we don't know why, but the data shows it's reliable and it predicts. So it's a touchy issue. You can see how it's broken up by percentage of individuals. 19% unknown. If you think about it, insurance companies don't collect information on race, so they had to kind of guess on some of that. You can read through how they actually figure that out. And then you have the charts. Some of these charts are really, really hard to read, so I'm not interested in them. There are some charts important. All right, so here's another definition. Frequency and severity gets into the pure premium or a loss ratio. So they're using both the pure premium and the loss ratio. There's a good definition down here. I forget which one they use for which. I think they show you up here. So auto insurance, they're using the pure premium. And so they must be using the loss ratio for homeowners. Yeah, okay, so auto, they're doing pure premium. And homeowners, they're doing loss. So pure premium, that's what the premium would be if you only look at claims. You don't have expenses, LAE, all the other stuff, all you have. So if all they did was charge you for the claims they expect to pay you, that would be the pure premium. If insurance companies charge you that, then, you know, it'd be kind of break even. You would on average get as much money back as you paid in. You know, I always say you pay more for insurance than you expect to get back. Why? Because they add those expenses and the profit and all that on top of that. Pure premium is just the amount for the claim. It's that frequency and severity. It doesn't include loss adjustment expenses, underwriting expenses, profit. The loss ratio we already covered. That's just your claims divided by your premiums. So it's what percentage of your premiums do you pay out in claims? I can't tell you actuarially why they use pure premium for one and loss ratio for the other. And actuaries file pure premiums when they file their premiums to get state approval. So a very, very important chart is this one right here, chart 7 on page 19. This is auto insurance. This is the pure premium. So over here is the premium they would charge if they just charge the pure premium. And down at the bottom is credit scores spread out over 10 categories. I have people without a credit score. It looks like they're pretty bad drivers too. So the worst credit scores should be charged about $360. The people with the best scores should be charged about $175. So it's extremely materially different. Does it look like there's a relationship there? Doesn't like jump up every once in a while. It's pretty consistent, and it's much steeper at the tails too. So people with really bad credit scores are really bad drivers. People with really good credit scores are really good drivers, and you have to kind of the meet in the middle. Don't you wish they had used actual credit scores? You could see where you were on the list, but right. Homeowners is a little bit strange. So homeowners, this is the loss ratio. Remember, 300% is not a very good loss ratio. You charge $1,000 in premiums, you pay out $3,000 in claims. Not too good. So people with bad credit scores extremely risky. People with good credit scores are pretty much in line. But why is this so messed up? Because of that mold issue. Really messed things up here. So, and there's probably some sense of people with lower credit scores probably did have more mold claims than people with high credit scores. There was probably some relationship there, but the numbers were messed up. They were somewhat less conclusive on homeowners than they were on Ottawa because it was just bad timing when they did the report. So there it is right now. They looked at claim frequency and claim severity. The data shows credit score has a stronger relationship with frequency than severity. And I think part of that could be people with good credit scores have more expensive cars, so have higher severity that offsets that, but I can't prove that. As the credit score improves, the frequency decreases, people have fewer accidents or claims. Severity may decrease as well, but not at the same rate as frequency. For some data sets, severity is nearly flat. Here's frequency. You can again see a very strong relationship. And then severity, pretty flat line across. Both of those for auto insurance. The issue is not whether credit score is related to claim experience, but whether credit score provides additional information over and above traditional existing rating variables, which can enable an insurer to more accurately predict losses. That's studied too. So they say, okay, we established that impacts different groups differently. We've established, where did they go? We established that it's predictable by itself, but is it this keyword additional information? Do credit scores provide additional information? And then the appendix you can ignore because it's, oh my word, it's just actuarial. So there's nothing in the appendix to see. I've looked at some of these charts. I don't know who decided to do this graph. I don't think it's all that helpful. So I'm going to look back at the first article. So I love this phrase right here. I would work it into your answer. So essentially what he's asking is, are credit scores just a substitute for something that's illegal? And he has this phrase, credit score has earned the outward appearance of being a surrogate for something sinister. Isn't that wonderful? A surrogate for something. You should work that into a sentence, unrelated credit scores. That's just a surrogate for something sinister. It just sounds wonderful. It's really good, alliterative. But that's essentially what he's asking is, are we throwing in credit scores because we can't use other things? And the answer is going to be no, it's not, because whatever factor you look at, whatever group you look at within that group, credit scores are very predictable. Consistently, group by group by group, they're very predictable. So they're tremendous additional information. All right, any comments up to there, Jose? That's what I'm talking about, Jesse Jackson. So definitely in inner city areas where crime rates are high, homeowners insurance can be extremely expensive. And there's people in those neighborhoods who need homeowners insurance and they just can't afford it. On the auto side, there are places where auto theft can be an issue. And so they can get, inner city places can get charged more. I can't think of any like major cases that have hit that where they're just obviously doing something blatantly illegal. So it's hard to say. Most insurance companies aren't going to touch these issues. They're not going to even internally just see, we're just curious if there's a relationship here. So you won't. So I can't think of any major case, but you probably could. Jesse Jackson and the insurance. That could be your paper. That could be a paper two topic. His advocacy for minority participation in his effort to expand diversity within the sector. His work highlight the moral and cost-efficient benefits increase minority in the insurance industry and shaping his approach to diversity and inclusion makes an impact. That's not the issue I was looking for. I met Jesse Jackson when he tried to change the auto insurance industry. So he has a history with the insurance industry, and it was a very professional relationship. It wasn't like he was out protesting them or something. It was the two sides seriously sat down and said, okay, what can we do? Whether he got everything he wanted is probably unlikely, but so the industry has had, the main thing is the redlining has been that on the homeowners side, not so much on the auto side. All right, other questions? So we'll finish this up on Tuesday and we'll do the second study. And what do you think the results of the second study is? Does it provide additional information? The answer is going to be a strong, not only does it, they're going to use the word significant. So they're going to say, yeah, it does, and it does it very well. Just quick refresher, last class we're talking about use of credit scores. We're using pure premium on the auto side, which is what premium you charge if you only want to cover claims, and the loss ratio on the home side. Issues you'll see coming up later in the semester: affordability versus availability. And the insurance industry doesn't talk about affordability; they always talk about availability. Let us charge the rate that matches the risk, so we can sell insurance to everybody. We can charge the correct price. We can sell insurance. We won't leave the market. And others, consumer groups say, but that's not affordable. We have some really horrible drivers out there, are really dangerous places people live, but we should make insurance available to them at a reduced price, let them be subsidized by others, because everybody deserves insurance at a price they can afford. So it's this battle between these two groups. And I asked the question, do we, especially if people really are bad drivers, do we want to do everything possible to keep them on the road? I'll show you, I got to get the sound system working in here. But I'll show you some really bad drivers here, maybe next week. There's a really good TV show in Canada, is Canada's Worst Driver. I don't know if y'all have seen that before. It's I think I found the worst one of that entire. In fact, in the show, they say this might be our worst driver ever. Do you want the insurance industry doing whatever they can to keep people like that on the road? And then there's other people that they're not really bad drivers, but they're maybe just in an area that crime is higher or whatever, and they're going to have higher rates, not their own fault. So you can see both sides of that. The insurance industry says, we don't care, let us charge what we should charge. Everybody should pay the rate that matches their risk. And then I asked the question for those that are false positives. Someone who has a low credit score but is a good driver, is it possible telematics will adjust for that? And that would be a good paper 2 topic. Telematics is really a big thing right now. And so the state of Texas had this study. As far as I know, they're the only state to have done this. They did the initial study, which was the univariate study, and they asked 2 questions. Everybody remember the 2 questions? That's willing to speak out loud. So they asked, was there a disproportionate impact? Is the use of credit scores harming certain groups of people more than others? And the answer to that was yes. Probably the most sensitive is race and ethnicity. And then the second question was, is there a statistically strong relationship between someone's credit score and the way they drive? And the answer there was yes, primarily related to what? Related to frequency more than the severity. Study 2 said, you know what? Credit scores have a strong relationship, but maybe there's just a substitute for age or income or something else. Let's look at this, do a multivariate analysis. So in your exam question, you really want to talk about univariate, where in this first study, they just look credit scores and claims. They didn't look at anything else. In the second study, you say, what if we combine credit scores with other things? Do they provide, and this is really, really key, do they provide additional information? The answer there was yes, and the word they use is significant. Okay. And we'll see where it ranks versus other things, and it ranks really quite high. It's especially on the auto side. It's and I've always done this because I've talked to actuaries, and actuaries are like, yeah, there's no question. They didn't even need to do the study. We already knew. All right. So what we did last class is we got through the first study and answer those 2 questions. We didn't look at all the charts because there's just too many of them. So let's look at the second study. So what they found is for both personal auto and homeowners, credit score was related to claim experience, even after looking at those other variables. We'll look at the variables and see what they are, because that can be pretty interesting. Credit scores provides insurers with additional predictive information distinct from those other rating variables. Real critical to this study. It allows insurers to better classify and rate risk based on using credit scores. So it is valuable. You say, I don't like it, that's unfair. You have to say unfair to whom? It's if it's unfair to people with low credit scores and you fix it, then what happens? People with good credit scores are going to pay 30-40% more in insurance. So you have to, there are, what does Thomas Sowell say? There are no solutions, only, what do you say? Trade-offs. There are no solutions, only trade-offs. Have y'all heard that before? It's a really great quote. No solutions, only trade-offs. And that's what the thing is here. There's no solution for the use of credit scores. If you allow them, then people with bad credit scores will pay more, but they should, because they have worse driving experience. If you don't allow for it, then people with good credit scores are going to pay more. There's only trade-offs. For personal auto, credit scores were related to frequency. They defined that as the probability of filing a claim. They found little nor statistical evidence credit scores related to claim severity. We talked about that. That could be because people with good credit scores maybe have more expensive cars, and so their severity is going to be higher. Maybe there's an offsetting there. Homeowners, It was tough. It was related to frequency. The department found some statistical evidence that credit score is also related to amount, the severity, but they had a tough time because of the mold claims we talked about earlier. The whole mold thing was going on at the same time they're doing this study. And also storm events. So homeowners have some special events that can really distort the data because there's other things going on. Obviously, there's probably no relationship between credit scores and hurricanes. That people with low credit scores have more hurricanes than people with high credit scores. So big storm events probably are not related. Where does credit scores line up on auto liability? Credit scores vary in importance depending on the model the insurer is using, but generally comparable to territory and driving record. Comparable to driving record. Can you imagine? Credit scores are as useful in predicting claims as speeding tickets and accidents. That's pretty impressive. Only class, which is age, gender, marital status, was consistently more important. For homeowners, credit scores was one of several variables. However, I was able to draw conclusions mainly because the other things going on. Oh, I used the wrong word. It's not significant. What's a bigger word? Significant or substantial? Substantial sounds a little more powerful, doesn't it? So yes, substantial, and that was their word. The industry didn't write this. And that's for both. It was substantial. It is important to ascertain whether the relationship of credit score and claim experience provides significant additional information. So this is the second study. There's that word, multivariant. Here's where we get some really bizarre stuff that I can't answer because I'm not an actuary. This one sentence I thought was really peculiar. Some of you actuaries ask your statistics professor to explain the methods are categorized as either being statistical or actuarial. What in the world does that mean? What is something that's actuarial that's not statistical? Can you give me an example? A little bizarre, isn't it? Isn't actuarial science statistics? And I don't know what would be, well, there's probably a lot of stuff that's statistical that's not necessarily used by actuaries. The statistical methods involve construction of statistical models by fitting hypothetical probability distributions to the individual data. The actuarial method is calculated, it's almost like actuarial models are statistics, but using the jargon from the insurance industry. And that's about the best I can come just from that statement. But to me, they're all statistical. Here's the rating variables. The footnotes are pretty important, and you'll notice there's some significant overlap. So territory, they define that as your address. And by that, they mean where the vehicle is garaged, not where you drive to work, but where it's garaged. For territory for homeowners, pretty obvious. It's where your address is. Class includes a lot of things, which this is where you see the overlap because class includes age. And then they also have age. So you got age in there twice. Class reflects age, gender. So young drive worse than older, except for at some point, the older start driving really badly. Gender, women drive better than men. Married people drive better than single people. Combined with how many miles, so class is huge, right? This is about everything, how many miles you drive. And I don't know why they have age in there twice. Basic or higher limits, that has an impact. I don't know if they define basic high limit, whether the policy involves a minimum required limits, or if they get more coverage than the state requires. Multi-car discounts, how that affects probably doesn't have a big impact on frequency or severity. And then do you get the auto and home discount? Driving record points, you probably think that's kind of part of the class, but not really. So driver points, driver record reflects at-fault accidents and serious vehicle-related convictions. I don't know if speeding is a serious vehicle-related conviction. Obviously, driving under influence would be in that category. And then credit score is in there, and credit score is in there. Homeowners have protection class that usually has related to where the fire department is located. That's probably the most important thing. Are you near a fire hydrant, though? Can also be there. Construction class, how the house is built, how much insurance, very similar to the basic or higher limits. And then the other ones are there, and then credit score. So this is a good list. This is what the insurance industry is looking at to assess, and credit scores ranks up there with driving record. Just pretty amazing. In every case, analyze the statistical approach to identify credit scores as being related to a statistically significant way and a significant way to claim frequency. So there's the word significant again. I guess they use both. For homeowners, the department concluded credit scores as one of several, but you couldn't come to a strong conviction. And the problem with the homeowners is they had these very few but massive claims that distorted the data. This is a concern because unusual circumstances regarding mold claims were present in the data. When water damage and weather-related claims were excluded, the average ranking placed credit score almost as important as the most important variable, followed by territory, deductible, and age of home. So you take out all that mold stuff, it went to the top of the list. The rest of this, I just want to let the actuaries see kind of the kind of numbers that we dealing with. So how many, I don't know how many people live in Texas, maybe 40 million people, but how many different categories of kind of risk pools are there? And in Texas, you can get 3.6 million different categories. So 50 territories, 20 classes. So 20 doesn't sound like much, especially talking about age. I'm not sure exactly how they break it up. You know, probably at age 25, that goes pretty far in. Five driving records. It'd be interesting to actually see those 5 driving record groups. 10 credit scores. We saw that before, 10 categories. Multi-car groups, companion policy groups. So you multiply all those out together, you get 3.6 million. There's probably someone in every one of those categories in the state of Texas, I would imagine. And it's now some actuarial stuff. Regression analysis identifies and measures the relationship between the dependent and explanatory data. It does not provide causal information. We talked about that. Actuaries don't care about causal relationships, they care about correlation. So they don't need credit scores to cause people to drive badly. They just got to say, hey, something is related between the two of them. Credit scores are really easy to get our hands on. So we're going to use credit scores. Maybe it's a proxy for something else that we can't measure, but correlation is the key. And here, I've always mispronounced this word, so I won't even try. And I haven't had this stuff since I was in college, so it's been a while. So actuaries, y'all can explain all this. Generalized linear model using Poisson probability distribution was used to analyze claim frequency because it is a standard approach to problems with this type and has been used in other insurance and non-insurance applications. It also found to be the best approach to account for varying policy periods. Do y'all use this distribution? Is it pretty comfortable? Okay. The generalized linear model using a gamma distribution was used to analyze claim severity because it's one of several models commonly used. The exploratory analysis indicated that if other reasonable distributions were used, similar results were attained. I'm not real familiar with the gamma distribution, but your choice of distribution is obviously pretty critical in this type of analysis, especially given we're talking about things that are kind of lumpy on the insurance side. And you got different timing and other kind of things. This distribution implies that the expected number of claims is proportionate to the length of the policy period is commonly used in insurance models. The department noted that some statistics, deviance divided by degrees of freedom, indicate the actual data were less dispersed than expected. The department did exploratory analysis to make adjustments and determined that the degree of significance indicated the models used, if anything, understated this relationship between credit scores and claims. Did the department do that, or did they use actuaries in the field to do that for them? you have to be a little worried if the actuaries working for the companies are doing this work. There's some bias there. The insurance department has some impressive statisticians working for them, so they probably could handle this analysis. The gamma probability, which adjustment reflecting the impact of deductibles and policy limits. This distribution commonly used for models to model severity. It assumed that the average claim amount for a given policyholder is a specified function of the rating variables for that policyholder. With these assumptions, statistics were calculated to determine the parameters in the formula relating rating variables to the expected claim severity. I remember chi-square. We used that when I was in college, but I use it. I can't remember using it in finance. It seemed really powerful and useful, but I just don't remember using it in finance. So y'all use that in your classes? Sound familiar? Statistical data was used to evaluate whether a set of rating variables were statistically significant as a group or individually. This approach tests the null hypothesis. Y'all probably done that. The p-value measures the probability that chi-square statistic equal or greater than that actually observed. If the p-value is small, the null hypothesis was rejected and the rating variable accepted as being statistically significant. So y'all done this in your stats classes, right? So this isn't real radically new stuff. They did say they threw out R squared. That's the one statistic we finance people love because it's nice and simple, but they said it didn't really work well in this analysis for some reason. It is not applicable to the type of regression that was employed. I only bring that up because in finance, we tend to use the same stuff over and over again and never ask the question, is this the most appropriate statistical model to use? Mainly because we don't have the math of actuaries, but it is pretty important to ask those questions. Yeah, they talk about how R squared just did not do a good job. So I think that's it. So let's look at the class notes, just make sure we've gotten through everything. So, and your exam answer, the 3 discriminations I think are really critical here. 2 of them are illegal. 1 of them is legal, unfair. And remember, I don't really care if you get the first 2 definitions because I think they're switched in my mind. Unfair discrimination and intentional discrimination. Unfair discrimination is when you charge people in the same class different rates just because you don't like them. So insurance must also always be supported by statistics. You can't charge A more than B unless you can prove there's a frequency or severity difference there. Intentional it's illegal even if you can't show it's actually sound. That's race, color, religion, or national origin. So if Methodists drive worse than Baptists, you can't charge them more. No matter what you want to do, it's just not legal. Disproportionate impact is, and even in some of these groups, you'll see some of them are harmed more than others as a group, but it's not illegal, especially if within the group, it still works. So people in that group with good credit scores drive better than people with bad credit scores. So that's disproportionate. And then my favorite phrase in there, unless credit scores are a surrogate for something sinister. What does that mean? If credit scores can perfectly predict a class that is protected, and we saw that's not the case. There are correlations, but and differences in a group, but it's not a perfect predictor, even close, not even close. So it's not illegal unless the state of Texas makes it illegal, like in California, they make it illegal to use credit scores. And again, remember in California, you can't use credit scores. You're penalizing people with good credit scores, and you're helping people with bad credit scores. So the Texas Insurance Commission said you can only make it illegal if it's intentional, unfair. It cannot make it illegal if it's disproportionate. Only the Texas legislature can do that. All right, we talked about the 2 phases in there. And its credit scores significantly improve. We talked about the availability, affordability are pretty important. From a society standpoint, I'm of the opinion that we should charge people for their risk, especially for driving behavior, I can kind of see, we're talking about Jesse Jackson saying there's certain neighborhoods that are harmed because of the way the insurance companies. Great, I can see that argument. But if someone really is, credit score shows they really are a worse driver, they should be charged more. I think we as a society should, we provide buses and other things that people can use if they're really bad drivers. So we'd be better off as a society if people that are really bad drivers just are off the street. But that's the insurance argument. Probably known though is the other side is people with bad credit scores often have a lot of other stuff going on in their life. The last thing they need is to be paying 40–50% more for auto insurance. So I can see that argument as well, especially if they're paying more, not because they're bad drivers, just because maybe they're in a more higher crime area or whatever. And that's where Jesse Jackson really got onto the industry. He said, man, you can't penalize people just because of where they live. And in false positives, people good with bad credit scores, you drive well. That's where I asked about telematics. And people question why my credit score is being used to charge me more for insurance. They can understand why the bank denies them a loan or charges them more for a loan. That makes sense. But why isn't an auto insurance company charging me 40% more? So again, that's something surrogate for something sinister. We talked about that last class. How material is it? Pretty material, especially on the auto side. By its nature, insurance is discriminatory. We talked about before, and especially those two biggies. They can discriminate on age and gender. Almost no other business can do that and do it quite legally and quite materially. They can charge men a whole lot more for auto insurance than women. And because it's very material, if the state were to disallow it, be disruptive. I think in paper 2 topic, I think would be really interesting is what is the impact in California of not allowing credit scores to be used for auto pricing? How material is it? Are there people complaining? California also had a vote where they want to make it illegal to charge people living in a city more than people living in the country for auto insurance. Over 90% of the people living in cities voted for it. Over 90% of people in the country voted against it. Why? Because obviously people in the city are going to have more accidents, have more claims. So the insurance industry says, yeah, that's terrible. You're overcharging good risk, you're undercharging bad risk. But so California would be a good test case to see is this actually working? Is it something, you take someone with a good credit score living in the country, they may be paying 60, 70, 80% more for auto insurance than they should be. Would that be enough to get you to move to Texas? 80% of auto insurance? I don't know, but you throw on the housing pricing and other things, it starts adding up, make it really expensive to live in that city. The next state, what if you have bad credit scores and you live in the city? Would that be enough to get you to move to California because you're saving on auto? I don't know if it's that material. Auto insurance is a pretty big bill for most people, much more than homeowners for most people. So the question's answered. Credit scores have a correlation to frequency and severity. Yes, but much more to frequency. Does it have a disproportionate impact to certain groups? Yes. Are credit scores simply a surrogate for something sinister? No, because you can't use them to perfectly predict or even come close to perfectly predicting any of these subgroups. Do they provide additional predictive information? Yes, significant, substantial, whatever S word you want to add. So let's talk telematics. This article is a little dated, but not too bad. I can't remember where if you're looking for a paper 2 topic, you'll probably won't care about it until after exam 2, but IIA is a really good website. Forget what it stands for, Insurance Information Institute. Those that went to the symposium, I think they usually present there. Some really, really great stuff on their website. They're an industry trade group that provides information to help insurers manage risk better. So this is an article I got from them. So we talked pay at the pump. So make people buy insurance at the pump. That way, people who drive more are going to pay more, and people who drive less. And then electric vehicles somewhat mess that up. So what III is saying, maybe we can do pay as you drive auto insurance, but using telematics. So every driver gets their own specific rate based on how well they drive, how many miles they drive, how safely they drive. USAA doesn't do this, but I know there has been some discussion of actually seeing if you're speeding or not. I don't know how accurate the systems are. I don't know if y'all noticed on 1604, when the sign says the speed limit is 70, my car says it's 60. And when the sign says it's 60, my car says it's 70. And it switches almost, it's like someone got them mixed up. So I don't know how accurate my telematics would know, because I go with the sign. Right? Do y'all go with your car, or you go with the sign? Which is more, what's the police officer is going to go with? I'm guessing the sign's going to be much safer for me with a judge. Yeah, the sign said 60, but my car says it's 70 here. I don't know if they would go with that. So that may not be quite so accurate, but certainly cars have the ability to do that now. My GPS will tell me, yeah, you're driving a little fast, you're a little slow. It's like leave me alone. So technology insurers can use to fine tune their risk profile and tailor auto insurance to the specific driver, also referred to as usage-based insurance, UBI. UBI is not a good term. Why is that not a good term? What's the other term? Yeah, universal basic income. So I wouldn't use UBI. People get really, what does that have to do with auto insurance? It captures and evaluates how you use your car. Data collection mechanisms, including smartphone apps, plugins, and hardwired devices, can be used to monitor driver behavior. It's voluntary, but again, I get you back to Root Insurance Company. For them, I don't think it's voluntary. I think it's just implied. It's just implied in when you sign up for the contract. Yeah, and I don't know if I can go through all of that, but drivers in San Antonio can save $610, maybe. Obviously, if they pick the most expensive insurance company, it's possible you could save $610. I've had some tell me I could save more than I was actually paying. It's like, man, that's great. You're gonna send me $100 and give me auto insurance. Data collection mechanism. Okay, we got to get that. Telematics programs give drivers a financial incentive to drive less and to drive more carefully. So that my app doesn't count how many miles I'm driving, but it does do mainly. Am I using the smartphone and do I hit the brakes too hard? The more positively drivers react to the incentive, the less they pay for insurance. And then you're also seeing this on the commercial side, where you're monitoring your fleet drivers, and that can be pretty material to a company, especially if they're doing a lot of driving. Distracted driving in the United States rose more than 30%. We're more on our phones. That's when I show you those Canadian drivers. There's two in particular, a man and a woman. I'm not going to show you the man, but this young kid, maybe 18, 19 years old, had a wreck because he was constantly on his phone. So he had a wreck and he broke his arm. And they're now showing him using his phone with his left hand because he can't hold his phone with his cast. And he's still doing the exact same thing he did before, but now it's far more dangerous because now he's like driving with the cast on one arm. It is crazy what people will do. Some in your generation can't, well, some of your grandparents too, can't go more than 3 minutes without checking their phones. And it's like, you wouldn't believe it. When I was in high school, if someone needed to talk to me, they would have to call and I might not get back to them like for 12, 14 hours. I mean, it was amazing. And most of the stuff people are texting you, how much of the things you get text need immediate response? Like if you don't respond, someone's going to die. If you waited 2 hours, they'd probably call the police on you, right? If you waited 2 hours to respond, oh, they must have had an accident. But yeah, we're so distracted now. I turn my phone off. It's out of my sight. There's no way I can possibly use it when I'm driving. If I'm expecting an important call, if I hear the phone ring, I pull off, I park. I'm not gonna allow myself, especially since I teach this class, I can just see from the front page that I crash into someone while I'm on my phone. So it's a huge issue, and that's why they check phone usage very carefully on these apps. Drivers in January 2022 averaged 1.35 seconds of phone distraction per hour. National Highway Traffic Safety Administration, this is another good website. In fact, this is my favorite one. We'll do some of their stuff. I can get into it. Probably have the typo. So you know these guys pretty well. You've seen the crash test dummies. Are familiar with them? These are the crash test dummy people. They have one. You could do your entire paper from their site very easily. There's so much stuff here, and they do have videos somewhere. I don't know where to get to them. Child safety, teen driving, older drivers, pedestrian safety, bicycle safety. I should do that one. School bus safety, vehicle safety. They test different cars and give ratings to them. They have a lot of research you can get into. They test things like, we'll talk about this, the roundabouts. How material are those? And those have been really pretty effective in reducing, especially severity. Automotive, look at these topics. There's so much in there. Vehicle safety research, crash industry research, driver simulation, child seat research. So their goal is to work with the insurance industry, figure out what's causing accidents, and then try to change the auto manufacturing or change laws or whatever. I mean, there's good examples of this. There's in some countries, if they would just put curbs on the roads, accidents, especially pedestrian deaths, would just plummet. Just putting up curbs. There's some simple things that aren't that expensive that reduce risk significantly. That's why roundabouts are so important. I don't know how to do a search, but I don't know if it's one word or two words. I don't even see it in there. But they have studies on roundabouts, and it's, in fact, someone in the previous class, I think, did an entire paper on roundabout. Or no, they did it on, yeah, one really good topic is how has this organization and the insurance industry changed how cars are built, how roads are managed. And one of their analysis was on roundabouts, how the insurance industry is really pushing roundabouts. Have y'all driven on Bandera outside the loop and seen those big turnarounds you got to do now? Well, talk about that. The most dangerous thing you do all day is red lights, and I'll show you some videos on that once I get the sound to start working again. But a lot of research on that. So attributes to behavior, the 410 fatal crashes every year. Telematics continuously monitors mileage, driving behavior, other driving factors. This is more reliable information, helps insurers accurately gauge risk. Set rates. I don't think USA is using it to increase rates. They're only using it to give discounts right now. If they use it to increase rates, they have to get that approved with the state. So they can't just start doing that. They have to prove that it actually works. And do a better job of customizing insurance products. Provides immediate feedback that can help change. So that's the other part of this. Does it actually change behavior, and how long does it work? So you get the telematics, so you're a real careful driver for like 3 weeks. Does it wear off and you go back? That's the kind of things they're looking at. So 45% of drivers said they made significant safety-related changes in the way they drove. Probably the biggest part of it was putting the phone down. As you get home every day and telematics gives you a low score because you were on your phone, people start doing that. Additional 35% said they made small changes, although many individuals who made small or significant changes ultimately returned through their old habits. 1 in 4 reported they considered the changes made to be permanent, and 19% saying they engaged in previous driving habits only rarely. Can you trust surveys like this? Who knows? But it's certainly going to be in the data. And that to me is, I had one student, a former student, speak. She worked at UTSA. She wasn't in the actuarial field, but she was in their data science department. It's really hard to tell the difference between data science and actuarial because half of the department were actuaries. But this is one of the things she was studying is how is telematics going to impact us? What can we do with the data? And it was really, really fascinating. Now, unfortunately, she changed careers. She's a really good speaker, a very animated speaker, but she changed careers, so I can't ask her back. Many states require insurers to obtain approval. They can't just start changing premiums even if they find the data. So they have to have that statistical support. We saw that with the credit scores. So there's so much here, and this article is 3 years old or 2.5 years old. Plenty of stuff out there. You can just Google it. How has telematics changed auto insurance? And all kinds of stuff will come up. Even AI's jumping in on it. And then, yeah, even more specific, AI with telematics. So you sometimes, and that's where root insurance comes in. Root insurance is telematics, and it's also a big AI shop. Very interesting thing. If I were an actuary, I'd love to work with a firm like that because it looks like there's a kind of leading edge, really, really trying to take advantage of what data they have, and essentially telling their customers, this is the company we are. Come to us. We're going to figure out if you're a good driver or not. If you're a good driver, we'll keep you. If not, we're going to charge you a lot and get rid of you. It's an interesting approach to insurance. All right. So we kind of talked about this before, but can you be an insurance company that says we're just not going to discriminate? So the good insurance company says we're going to charge single and married drivers the exact same premium. We don't want to discriminate. That's not fair. I kind of like that. I'm single, so yeah, don't charge me more just because I'm single. So we're going to charge them all $500. The evil company says our data shows that the pure premium for married couples is $300. For single drivers, it's $750. So we're going to charge, this is the pure premium, so they'll add on expenses and other things, but the pure premium. We'll charge married drivers $300 and single drivers $750. So what are the single drivers going to do? Which company would you go to if you're single? Go to the good company. What are the married drivers going to do? The evil company. So the evil company is going to charge married people $300, and their experiences, their losses are going to be $300. So they're not going to really notice it. What's the good company notice? They're charging $500, but what's their claim experience going to be? It's going to be $750. What are they going to be doing pretty quickly? Raising their rates pretty quickly, and probably above $750 because they're only going to make up for their past losses. So if you don't discriminate, all the single drivers go to good company. All the married go to the evil company. The evil company does fine. They're charging exactly what they should, but the good company is eventually going to either go out of business or have to move up the rates. Once they increase their rates to 800, because they have to offset those prior losses, then all the single people go to the evil company and get 750. You can see the incredible importance of actuaries and actuarial science. Actuaries are not allowed to talk to each other between companies on rates. It's illegal. Every single actuary meeting I've had with multiple companies, we used to do them at UTSA. We'd have another company come in. They start every meeting with, we are not talking rates today. Make that clear in the notes. So they're not allowed to do that, but do they know what's going on? Certainly they do. They have research and other papers and probably some university research papers, but they certainly notice it. The filings are public filings, so you can certainly figure it out. But you can see how you could add tremendous value as an actuary if you discover some relationship no one has discovered before. It gives you a huge advantage because now you can, and this is what the availability insurance company said, we can more precisely price. It just gives us a huge advantage competitively, and it benefits those drivers that we're assessing them more accurately. The only way you can keep companies from doing this is to make it illegal. You have to tell them they cannot use that information. And when you do that, just like Thomas Sowell said, no solutions, only, I forgot the word. Only, what did I say? Trade-offs. Thank you. Love that quote. I'm reading a book by Thomas Sowell right now. I heard him talking about it, and so I went out and bought it. And I think I got the wrong one because this one's like 20-something years old. So I think he wrote a newer version, but he's still a really good writer. No solutions, only trade-offs. That's essentially what's going on here. Someone's going to be hurt. Someone's going to be helped either way. The insurance industry says we want to help good drivers and get them the right rate so that we have better people driving. And the bad drivers, at a minimum, let us charge them more because maybe then they'll become better drivers. Give them some incentive to get better. If we charge them the same as everybody else, they have no incentive to drive better. If we're charging people using their cell phones while they're driving, charge them more, maybe we'll get them to stop. If we don't charge them more, they have no incentive to stop. So it just doesn't help. You can get a spiraling issue here where the good risks, they just drop out of the system. They say we're not going to overpay. And you end up, that's that article I talked about, the market for lemons. You end up with just nothing but bad players because the good people just don't, they know they're overpaying and they just like, we're not going to do that anymore. Oh, there's IIHS. All right, there's one last article. It's kind of an interesting one for the state of California. And Allstate got in trouble, got sued in California. They agreed to pay $3 million, which seems pretty small for Allstate, to settle charges that they used negative credit information for a reason to deny coverage to at least 1,000 California car owners. Allstate says they didn't. So Allstate was accused of violating Prop 103 for redlining poor and minority motorists. The 1988 ballot initiative prohibits the use of credit histories as a factor in setting insurance rates. Allstate agreed to the $3 million, but not it broke the law. They said they didn't set rates. We'll see what they did instead. Insurers claim there's a connection between credit history and the likelihood of filing a claim. Is that claim pretty strongly supported? Yeah, pretty strongly supported. State Insurance Commissioner Garamendi, very famous person in the insurance industry. An elective insurance commissioner. What do you think an elected insurance commissioner is going to run on? I want everybody to pay their fair insurance rate, or I want rates lower. They're going to be focused on lower insurance rates. So I think this is like the craziest quote. This is the insurance commissioner, and look what he said. You cannot use credit scoring in California unless you prove it's not discriminatory. I mean, obviously, everything you do in insurance is discriminatory. You can't use age to price insurance unless you can show it's not discriminatory. Of course, I think what he meant was you cannot use credit scoring in California unless you can prove it's not disproportionately impactful, which we know that it is. So in that case, you couldn't use it. So I think that's what he meant. So of course it's discriminatory. That's the nature of the insurance business. So it's just a strange quote. So he's saying, this is discriminatory. Yeah, so is age, so is gender. There's a lot of discrimination going on here. The company used a variety of methods, checking credit scores, requiring one. So this is essentially what they did. They said, we're not changing your rate, but you got to pay the entire premium up front. And the state of California, so that's about this for most people, especially with bad credit scores, that's about the same as denying them coverage. I mean, would y'all want to pay your entire 12-month auto insurance all on the same day up front? Probably not. Allstate is huge. It said it used credit scores to determine only down payment amounts and payment plans, not the rate, the coverage. Heller said that using credit scores when selling insurance was a particularly insidious practice that made it hard for lower income motorists to obtain legally required auto insurance, even if they had no history of being risky drivers. He likened using credit scores to a practice of redlining. So you'll see that because there is a relationship between income and credit scores. It hasn't resolved the debate about using them when rating risk for homeowners policies. So in California, you still can use them for homeowners. Allstate. So when WOAI had this debate, it was an Allstate person on the line, I think with Joe Pags, and man, he just got beat up. All the calls coming in with people complaining. The guy was real friendly and nice about it, but he was getting beat up. Allstate is pushing for it to be able to use it nationally. Using credit scores increases the accuracy of our risk evaluation. And guess what word he's about to use? What word have I been saying over and over again? Starts with an A. Oh, come on. Oh, someone's going to remember it. Not affordability, but availability. What word is he about to? You can just see it coming. Increases the accuracy of risk evaluation, controls the cost of insurance, and helps us make insurance more available. You know, when the insurance industry wants to charge some people a whole lot more than others, they're going to use the word availability. And I love her last name, Wanamaker. So I don't know if she's still at Allstate. Great last name. So yeah, this is a big deal. Prop 103 was huge for the insurance industry. It forced insurance companies to cut rates. It didn't allow them to do certain things that certainly help some drivers and hurt other drivers. California is not a place I would want to have auto insurance. If you're a really good driver, a really good risk, you don't want to be in a state like Allstate. If you're, like California, if you're a really bad risk, it might benefit you. Anyway, all right. So there's auto insurance. I don't want to start commercial. We're kind of, all right, let's talk one other topic real quick. So next Wednesday at 4:30 in, I can't remember the room number. I think it's 2.0106. It's a big auditorium across from Richard Lee, I think. So the Chief Investment Officer of USAA is coming. Seth Vance. He's going to talk about investing at USAA, but he's going to talk about the property and casualty and the life side. We haven't talked about investing here yet. If you go to that talk, I'll give you, I'm giving you 3 absences you can make up. I'll make it 4 as long as you make sure I know that you're there. What questions could you ask him? So property and casualty, we'll talk about investing for property and casualty firms, but just a general question that would, he has a really strong background. I'd love to sit and talk to him because I've got a lot of the history of USAA. I could tell him some pretty shocking stories about USAA. So I'd love to just sit down with him and say, hey, let me give you 20 years of USAA investing because you won't believe what we used to do. But a really good question to ask, how do you set your strategy for a property and casualty insurance company versus for a life insurance company? How different is it? And is it materially different? Yeah, it's hugely different. What's the #1 risk for a life insurance company that the Fed does a lot with? Interest rates. That's their biggest risk. It's not people dying, not people living too long. It's interest rates. That's their biggest risk. How important are interest rates to property and casualty companies? No, kind of important, but not that important. So I'd be curious what his answer to that would be. Do you think he wants that question? That would be a pretty tough question, right? He knows the answer, I'm sure, but how does he explain it to college students when the answer is pretty complex? So if you go to that, let me just give you a little bit advance. A big fact for property and casualty companies, especially with homeowners, is liquidity. Because if they have a major catastrophe, they're going to get their hands on $2-3 billion. So they like things like treasuries. Treasuries are very Very liquid. Stocks are very liquid. You may not think of them as liquid, but they're very liquid. So the P&C industry buys treasuries and they buy stocks. The life insurance industry has no treasuries, no stocks. Um, Another factor you have is taxation. The taxation for life insurance companies means that they never buy municipal bonds. Municipal bonds are tax-free at the federal government. Property and casualty companies buy a lot of municipal bonds. Unfortunately, they tend to be illiquid securities, so they help them on the tax side, but they hurt them on the liquidity side. So P&C companies tend to be a bit barbelled. They have a lot of liquid stuff, and then they have illiquid stuff because they need municipals. They do buy corporates, but not nearly like a life insurance company could be 97, 98% corporate bonds. They might have some commercial mortgages in there, but they just buy a lot of bonds. Why? Because it's all about interest rates. It's all about the spread. A property and casualty company will not be that heavily allocated. In fact, Allstate, we're just talking about Allstate. I've seen Allstate have 40, 50% of their assets in municipal bonds, which seems kind of crazy to me because they're pretty illiquid. But that would be an interesting question. A question that I would love, I mean, maybe I should feed y'all questions because there's questions I'm really interested in. But how does USAA invest differently than other insurance companies you've worked with? Did you walk in and notice something different? And were those differences things you wanted to change, or did you find some stuff that you like better? You know, wouldn't that be a great question? Would he want to answer that being recorded? Probably not. But if he's not being recorded, he might actually give you the answer. I would love to hear that answer. I spent an entire year. I was called on the phone. I was called and say, Ron, we want you to work in investment strategy analysis, and you better not say no. So I said, okay, that sounds good. I'll do that. And we spent our first year doing nothing but analyzing what a property and casualty insurance company should be invested in. And we went out to look for studies, and there were no studies. No one had ever asked that question before. And because of that, I went around the country doing presentations after that because we're like the only ones who'd ever done it. Rating agencies were calling me like, what have y'all discovered? This is really interesting. So we sat down, three of us did nothing for a year but researched that question. So I'd be really interested in what his background is and see what he has to say. He has a Harvard degree, he has a strong investment and insurance background, but I'd be really curious. So how many of y'all think you might go 4:30? Can y'all do that? 2.106. So if you go, make sure I see you there and give you credits. So